Hello and welcome to another trades and tutorials video from the Little Big View section of Market Gauge. This is Jeff Bish, president of Market Gauge, and in this video I'm going to show you how you can use the opening range to deal with a lower gap. Now you may be trying to deal with a lower gap because you're in a position and a gap's against you. I'll do that in a different video. In this particular video, I'm going to focus on the fact that when the market gaps lower, there are certain places you might want to look in the markets to find a good opportunity, and here's an easy way to play it and assess it. So if you're familiar with Market Gauge at all, you know that we're big advocates of the opening range, and I'm not going to have time to go over all the everything I'd like to go over with respect to defining the opening range and how to trade it, because there's so many ways to do it. But you can find all kinds of information on that, including free reports on our site, marketgauge.com. What I am going to show you is basically how it works. So what you see on my screen here is a chart of XLV on a daily basis and XLV on a 5-minute basis. And then on the bottom, you see the SPYs on a daily basis and a SPYs on a 5-minute basis. And I'm going to focus on what is now the day before the day we're trading. So you can see that on this particular day here, the market gapped lower. It gapped lower from here on the daily down to here on the daily. On the SPYs, it gapped from here down to here. And you can also see on the SPYs here that the SPYs are in a relatively tenuous situation, with this magenta line being the 50-day. Down here you've got the 200-day, but clearly we've broken the 50-day, rallied back up to it, and now the market is heading lower as it's gapping down. So this, on one hand, could be viewed as a really dangerous or bearish gap down. On the other hand, you could look at it and say SPYs, they might hold here because there's got to be some support, or there should be some support. But you want to be able to do this in a risk-conscious way. So one of the ways you can do that is to use the opening range. And just as a quick jump start, if you're completely unfamiliar with the opening range, we're talking about the first X minutes of the day. Either the first 5 minutes or the first 30 minutes is a good start. On the charts to the right here, when I have the 5-minute charts, you can see 5-minute bars. So the easy way to define the 5-minute opening range is simply to put lines next to or at the top and the bottom of your first 5-minute bar. Now I could draw those all the way across the screen, I just didn't. Now what I want you to focus on with respect to this 5-minute range is the relationship between the trading around that first 5 minutes in the SPYs versus the XLV. So the SPYs gap lower, and there's a better place to go very often than just the SPYs in this situation. Now the SPYs happen to be a good support on this particular day, but on a day where it isn't at good support, this is still going to be a great tactic for finding good trades. So if you're aggressive, you'd look for a break above the 5-minute OR, and your risk at worst is the low of the day. Now the reason you would use the 5-minute is because it's going to give you a tighter risk. The reason you might not want to use the 5-minute is because it's a lot more volatile. It's easier for the market to come back down and break that low than if you were to use, say, the 30-minute. So I've got the 30-minute opening range on my charts here. So there's the 30-minute high and low in the SPYs, and here's a 30-minute high and low on the XLV. Now, the other red line in here is the prior low of the day, and the red line here is the prior low of that day in the SPYs. So the thing I want to bring to your attention again is that if you were to focus on the XLV 5-minute breakout breaks out, moves higher. So does the SPYs, all right? Now, the XL, they both end up breaking out of their 30-minute opening range as well. But here's where the video's point really is made. The SPYs are clearly under a lot of pressure. This is a negative market environment that we're looking at right now, although it might be at support. And so it's not surprising so that the SPYs work their way down. They actually go all the way back down to the low of the day. And had you been using the low of the day as your stop, you would have been stopped out. But look at the action in the XLV. So the XLV, if I draw the 5-minute opening range, it never even really gets back into it. And oftentimes you'll find that the high of the 5-minute opening range does become support in the way that it has here. And in fact, it was support on the SPYs too for a while. And when it finally broke down through that support, that was where it decided to go all the way down to the low of the day. But it also broke out of the 30-minute and for all intents and purposes pretty much held the 30-minute. So why would I pick the XLV? Well, first of all, I've shown you that I'm using the opening range in order to define my risk. I'm also using the opening range to define whether or not I even get into the gap down, because remember, if the market gaps down and never takes out its 5-minute or its 30-minute opening range, I'm not going to get in. So the opening range keeps my risk in line. It serves as confirmation that it's even worth taking a trade like this. But also a big factor is what you pick in terms of your selection. So why did I pick XLV? Well, if you've been following the recent videos on this same location, you'll probably know exactly why. Over in the little big view area of marketgauge.com, which you'll find on our homepage under resources, little big view. Now, if you go there and then go to the sector summary, you will see a chart or a table of major industry or sectors in terms of ETFs. This particular table, for good reason, is ranked by the strength over the last 6 months. Guess who's at the top? XLV. So when the market gaps lower, or the market's weak, or I'm looking for an opportunity on the long side on weakness, or even on strength, but certainly on market weakness, one of the first places I'm going to go is to this table to see if there's anything interesting going on in terms of strong sectors that may be getting pulled down by the market. And if the market just stabilizes, or even better, if the market rallies, these are very likely to be places that are less likely to break down if the market breaks down, which is what we just saw happen, and more likely to really rocket higher if the market does come back. So XLV, IYR, XLU are the 3 leaders as I'm doing this video, and they're leaders with strength. So that's exactly why I picked the XLV. That's one way to take the opening range and use it in the right place. Because if you learn more about the opening range, you'll find that one of the most powerful concepts of trading with the opening range is knowing which locations to use the opening range. Just using it every day on every chart is not going to get you the results that you want. But if you really understand where to use it, it'll get you better results than you probably realize. So now that you know how I picked XLV and really why I picked it, let's go back to the potential trade. Now, if you were a day trader, being quick and agile, or nimble, I should say, and being able to pick this up right out of a 5-minute opening range breakout gives you a nice day trade really quickly, or even day trade from the standpoint of it breaks out. You could easily get to a point where you can put in a no loss stop and see how it works out for the rest of the day. Or as a swing trader, you're in at a great price, not only for the day, but in this case, of course, you're also in as it gapped down, held the 50. Now, of the 3 ETFs that I pointed out were leaders, I did look at the other ones as well, and they had good qualities as well in terms of doing a similar trade. I happened to pick XLV, actually did this trade because I saw it back into this area of support and sitting on the 50-day moving average, and I'm looking for ways to build a position in the event that it might break out to the upside. So right now I've got a situation where I'm in at a great price. If it comes back and stops me out at no loss, no harm done. If not, like I said, I'm in at a great price. But a day trader as well certainly could have benefited from buying it around 69.50 and having the opportunity to sell it almost as high as 70 and certainly hold it all day in an environment where the market was weak and you were in a pretty good position. So hope that helps, and I'll see you in the next video.